All right. Hey there, everyone. This is the next video lesson in the bootcamp tutorial section. And this particular lesson, uh, I will really try and keep it under 30 minutes. I think I kind of rambled on and went a little long on that last one. But, you know, this particular lesson really will kind of dovetail, and I won't need to spend as much time talking about how to set up the different spreads. I think I spent a lot of time talking about, buying and selling and how that, creates a spread. This particular lesson is only going to discuss straddles and strangles, okay? How you buy them, how you sell them, what they look like. And then I also want to run through maybe for sure one, possibly two, depending on how long this gets, about, how they perform and when you may be inclined or decide to use them. You'll see right here now we have got, this is the Russell 2000. Again, it's, probably one of my core instruments I trade, so I'm always looking at that. And you'll see, we're coming down in here, find a little bit of support off of that. And if I wanted to construct a trade, first off we need to talk about and discuss what is a straddle, what is a strangle. I mean, what are you talking about? Just understand that everything from this point forward is going to be defined and considered a spread, okay? We are no longer trading single calls or single puts, but yet we are trading, maybe calls and puts, or maybe we're buying and selling just calls and different strikes, maybe buying and selling just calls in different months, buying and selling calls and puts in different months. I mean, it gets a little bit, deep, but from this point forward, we are done with the singles. That was, back here in month 2 and month 3. We are now talking just pretty extensively about spreads. And so for this lesson, a strangle or a straddle. I'll just come in here again. We're 15 days to expiration. Today's March 4th. And we will have deleted simulated trades, reset parameters, make sure we have our hide positions on, and portfolio beta weighted. Now, let's just say we come in here. I talked about being a directional or a non-directional trader. It's a whole nother lesson about trading mindset and how that plays a gigantic part, if maybe not even the biggest part in this whole game of options trading. But if I want to take a non-directional opinion, I can take a directional opinion, I can take a non-directional opinion. For this illustration, I want to tell you I'm taking a non-directional opinion. I don't know where the market's going, but I don't think it's going to sit right here. All right? So I don't have a direction per se. I don't know if it's going up. I don't know if it's going down. It might very well sit here and just trade sideways for the next few days. But let's just say we were coming up here, topping out all-time highs. We've hit it several times. We are on this gigantic run up, dating all the way back to essentially, early February, a month worth of, almost a 100-point move up in the Russell, which is, it's fairly significant. So let's just go with the assumption that I think a big move is coming, but I just don't know which direction. Well, you'll come in here, and let's just say that I want to construct what's going to be called a straddle trade. And a straddle trade is simply buying a call at the money, buying a put at the money. That's it. Very simple. And you'll see that, again, this defaults to the actual, buying the ask, selling the bid. And you're never, that's a worst fill possible. You're not going to ever get filled at that unless it's a really fast moving market and you're in a very illiquid underlying. So you'll see the call site is 15.65. So we will bring that down to 15.7 is close enough. And this one's 14.95. So we will go to the other 14.9 on that. So we paid a little extra for this one, paid a nickel less for that. So this straddle right here if I right click either the call or the put side, it does not matter. Analyzing a buy trade, I'm going to be buying a straddle. All right, so you'll see that it's $30.50 right now is what the worst price being filled at. So actually, you know what? No, I take that back. Create a duplicate order. You'll see that 30.50 is the mid. Good catch right there. So you'll notice that when you create these spreads, if I right click and create a duplicate order, it will give me what my NBBO price is, or which is the national best bid offer. Essentially, it tells you what the mid is for both of these, and it tells you what the natural. So natural is essentially a market order. And if you can imagine paying the worst possible price at $31.10, you'll see if I uncheck both of those, you'll notice that create a duplicate order. $31.20 is the market order right now, which is $31.20 on these singles, paying them, worst fill prices. But if we fill right at the mid, you'll notice that it's $30.45. Adjusting this down to $15.70, adjusting this one up to $14.75. You'll see that it's about $30.45, and that's always fluctuating. So the mid price is where you always want to start out at. Well, what does that look like on a risk profile? Well, that's what it looks like right there. I have essentially taken, going back to our prior lesson about just single, buying an at the money call, looks like that. Defined risk to the downside, unlimited potential to the upside. Buying an at the money put, defined risk to the upside, unlimited potential to the downside, and it just overlaps both of those at the same strike, 12:30. All right, so I'm basically straddling the market where it's at currently at 12:32.38, and I don't know where it's going to go. If it goes up, I'll make money. If it goes down, I'll make money. But what I don't want it to do is just sit right here, because every day it sits right here, I lose, in theory, about $100 a day. Why on earth would anybody ever trade this, then you might ask? Well, I'm so glad you asked me that. What about going into earnings? You're expecting a big move. What about topping out right here at this area? What about coming off of a swing failure pattern or a swing point low? Or, again, you can fill in the blanks with any scenario of when you might find this a really, really instrumental way to trade, to where you might not have an opinion about a direction. You don't know if it's going to go up or if it's going to go down. But what you do know is you're expecting or you're anticipating a big move in one direction or the other. So this becomes a really key trade when you want to identify certain areas that you want the market to move in. All right, so you'll see the maximum I'm going to lose on this trade would be $3,065, but in exchange for that, I am putting odds in my favor that I've got unlimited profit potential to the downside, unlimited profit potential to the upside, and a narrow window from about 1204, or we'll just say from 1200 to 1260, to where I don't want it to sit. I do not want it to stay there, because if it stays in that range from there to there, you're going to lose all your money. Okay? So you can see, if I come back to here and I wanted to construct a trade that maybe I felt it was going to move up, so I construct a straddle much higher than where the market's at, well, it's going to be cheaper. Conversely, if I wanted to construct a straddle that was well under the market, it's going to be cheaper. But just know that that's how this trade is constructed. A strangle is exactly the same thing as a straddle, with the only difference being, instead of coming right at the money, you are going out of the money. So you're going farther away on the call side. So let's just, for example, let's go 30 points higher. We'll buy this 1260 call at 325, 320. We will buy this 1200 put at 660 or say 645. And if we, puts or calls, it doesn't matter which side. If you right click, analyze buying a strangle, and then what you'll have to do is you'll have to change. We've got 1260 call, but then we need to make sure that we change this to say 1200 on the put. Well, that's a $9.70 trade. So you'll see from the risk profile perspective, we take a really far out of the money call, much lower capital risk up front, okay, a $320 trade. You still have unlimited potential to the upside, but yet you have a longer ways. The market has to move a little bit farther in price direction. Price movement, it has to move farther before you start making that money. And you do the same thing with the put, define risk to the upside, but you've got that unlimited potential to the downside. It's just got to move farther, and you overlay them both. So now what you have done is you have reduced the daily cost of this trade, but in giving that up, now it has to move farther for you to be profitable. Remember the straddle, it had to move past 1200 and 1260. Well, now it has to move past 1190 or 1270. Okay, I think you can see that. Let me just come right here and add this. You can see right here, this little line right here, okay? This line here and this line here. Both of those is where it has to move past at expiration, this little green line. That's where the options expire. The white line is where they're trading at right now today. It has to get past this little hash mark for it to be a profitable trade on the downside, or past this little hash mark for it to be profitable on the upside. And then I can adjust these numbers up or down to reflect that, or you can also just grab them and move them to give you an easier visual look at it. So a strangle is essentially a straddle, but just with these option strike prices widened out. Now, you'll ask, why would you do that? Well, it's the same kind of thing. Maybe you don't really know in a direction, or maybe you're thinking the odds are higher that it's going to come down here before it goes back up, and then you can begin to start maneuvering. All right, let's just say I want it to be in a profitable trade from about 1220 all the way down to 1120. Well, if I construct something like that, well, if I wanted the super far out of the money put, we'll say I want it to be at 1120, and I wanted the call to be maybe right at the money or a little bit under the money. Well, now you'll see that's what this kind of trade is going to look like. It is going to be a lot more expensive, because then you start buying in the money calls, and you really have to move a long way for the trade to start making money. So straddles and strangles are generally utilized when you're coming right at the market and you don't have an opinion on direction. And I think you can probably understand, or you probably, guess, why would you ever sell one of these? And again, it just becomes, well, let's say that I wanted to analyze selling a straddle versus analyze buying a straddle. All right, the same price, whatever you buy it for, you want to sell it for more. Well, if I bought something right here and I want it to move right away, and if I take the flip side of that, well, now if I sell something, you see this theta number right here. Options is all about theta. All right, it's all about the time, and if you're keeping this number positive, that's what you want to make every day. If that number is negative, that's what you're up against, and that's what you're fighting. So if I sell a straddle, well, now I've taken the exact opposite position where it needed to be. If I let me slide this over so you can see what I'm doing. If I click here, set slices, come over here to break even on the expiration date, you'll see what that does is it automatically puts those to where I need to move. If I add this price slice for where the market's actually trading at, that'll bring it in there. But you'll notice that every day I'm going to be losing about $95 when I buy a straddle. When I sell a straddle, well, the break evens are still the same. They haven't changed, $11.99 to $12.60. But now, if we stay within that range and we do not move outside of it, I've got the potential to keep 100% of this credit that I took in. It's the same thing as the credit spreads in last lesson. You keep that credit and it stays in your account, but know that if it moves past that, you're going to lose that credit. You're going to have to buy that spread back and you'll take a loss. Again, this cannot be done in a retirement account, and it most assuredly cannot be done in a simple Reg T account unless you've been approved for being able to trade naked. I, to this day, will never trade naked. I think it's a danger. It's a recipe for, let's face it, anything can happen in this market at any time for any reason. You can have computer issues, you can have electricity issues, you can have broker issues, you can have geopolitical issues, you can have anything happen. Why on earth would you ever trade anything naked when you don't need to? You can get a very similar structure profile and not put yourself to this unlimited risk of margin calling or blowing up an account. So just don't do it. But in a portfolio margin account, it will permit you to do that. Like I said, as long as you are approved and qualified to do that trade. And there are a lot of traders that trade naked options. Me personally, I don't do it. I'm not saying I will never do it, but for now, I have never done it up to this point, and I don't foresee myself doing it in the near future. But the straddle, when you sell a straddle, you'll notice that now all of a sudden you have got a very narrow window, but you're generating positive decay or positive theta. Time premium is decaying, and if this is what you sell a straddle for, and you advance forward in a couple days, maybe you only want to make a couple $100, and you're willing to, take on this kind of risk, knowing if it comes against you one way or the other, you'll just close it. That's a very valid method, and a lot of traders trade this way. But it's the exact opposite of what you're doing right here, where you've got that unlimited potential. Strangle, I'm sure you can deduce that it's exactly the same. It's just a little bit wider out. So, if we're going to sell a strangle here, it's the same kind of thing. If I sell the 1200 put and I sell the 1260 call, all that has done is that's just widened out the strike price that I'm either buying or selling. In this example, that's the one I'm selling, and so my net credit that I receive is less because the strikes are farther away from where the market is trading at. Okay, so that is the straddle, that is the strangle. Let me run through a quick example, and I'll show you when that might be an ideal time to do something like that. Let's look at Apple, all right? And I'm sure that these are earnings gaps, or this might be when they split. I'm not, let's do Priceline instead. That'll be a little bit easier. Let's just say we'll come right into here. So let's say that this hasn't happened yet. Priceline is trading right around this area here. We'll say it's you see this gap open and it comes all the way up here to 1100, and you're fully convinced it's found a double bottom. It's got good firm support, and you want to go ahead and execute a straddle. So I will bring over option view, and let me just add Priceline in here, because this is a way to just kind of step you through a real world, real-time example. So what date is this? February 12th. All right. So I will go back in time to 2/12/2015, and we'll just go right to the end of the day. So you'll see right there, Priceline it closed the day at 1092, and right here closed the day at 1091.95. All right, fine, close enough. So we open up Priceline. And you will notice we've got several choices to pick from. We can pick options that expire in 9 days, 37 days, 65 days. Just know that the more time there is until they expire, the more expensive they're going to be. But let's just say we pick 37 days. That's fine. That's a reasonable time. We come right here. We buy one call at the money. We buy one put at the money. The call is going to cost us $3,900. The put is going to cost us $3,700. We convert the trade, and that's what it looks like. It's very similar. You can see exactly what I just got done showing you a second ago. Let's make it a little bit narrower. So you can see you've got that unlimited profit potential. And in exchange for that, you're losing about $100 every single day. Your delta and your gamma are essentially flat. Your vega is very positive. And this is what the price chart was looking like. So if we fast forward, let's just say to, what's come in here, let's say to the 23rd of February. And we will go right here. 23rd, it's gotten through it's gone through a weekend, a couple weekends, and now this is where we're at. So, all right, there you go. This takes it a second to update. You'll notice that not only have you lost, you've had to overcome that theta decay. Your daily theta was a minus $100, but now you have really moved way far away from where we were at before. And you'll notice if we would have stayed there, you'd be down a few $1,000s, but it moved a generous, amount in our favor, and we're up quite a bit of money. So you're at this point in time, you still have a fair amount of time until these options expire. You've got 26 days, and the option that is paying you, all right, think about it. You paid $39 for this one. You're able to sell it for $118 right now. You paid $37 for this one. You're able to sell it for $1. So you're losing on the puts, right? Because remember, what happened here with the puts when we buy this and we buy that. This is the put. It moved up a lot. So this is where we lost all of our money. This is where we made all of our money. So the loss that you have encountered on this put side is more than made up for the gain that you made on this call side. Okay, so it becomes very easy to see you want to take trades like this when you maybe expect a news event or earnings. You're expecting some kind of big movement. A lot of people play this game, and if it doesn't move the way you expect it to, you certainly will not capture these kinds of profits. Lastly, the reason why I want to tell you that, and I do not trade these straddles, is specifically if you are coming into, let's just say, an earnings announcement, right? I don't know if that was earnings or not. Let's go here, show corporate actions. Yeah, well, that's exactly what it was. So you'll see right here on this date, they reported earnings, they beat earnings at a conference call, and that's what the result was. Several days and for a couple of weeks prior to these earnings occurring, what you will notice is your volatility begins to increase. When volatility increases, because earnings are coming up, the cost of your options become more expensive. Okay, so write that down, rewind and replay this, let that sink in, hear it again. When you have uncertainty, and translation, earnings are uncertainty. When you have uncertainty enter the market, the way that the market makers and the way traders overcome that uncertainty is by increasing the cost of the option because there's more volatility. When it becomes more volatile and options become more expensive, you do not want to be buying them. You want to be selling them, okay? So straddles and strangles, that's what this lesson's all about. I hope that kind of helps you start putting images and graphs and pictures and a little bit of understanding to, you know, why you might consider using them, when you might consider using them, and just know that it's another tool in this toolbox of being able to understand how you trade options. You absolutely do not have to trade them. You need to practice trading them and, you know, scan the charts, figure out when you might think about putting a directional trade on. You know, you've already practiced putting on straight calls and straight puts. You've already been practicing putting on debit and credit spreads. Now it's time to practice with some straddles and strangles. See how they respond. See if you can pick a direction. See if the movement overcomes what your theta drain is or what your theta increase is. And that's the only way you're going to really kind of embrace and learn this, is by just practicing. So dig in, get in there, practice on the platform, and next lesson is going to be talking about ratio and backspreads. This one will probably be a long one. It's going to be a little bit more involved and a little bit more complicated, but let's just say that it further adds what I've been talking about with the singles. All right, I'm going to call the calls and the puts up here. Control-Shift-D. Sorry, I'm still learning those little drawing tools. I'm going to call this up here trading singles. I'm going to call this trading doubles. Didn't stay. This is trading doubles. This is trading doubles. This is going to be trading doubles and singles mixed in. So these are going to have different numerical amounts. And then when we start getting down to the lower lessons, then we're going to start talking about going across the months, all right? And that just means we're going to be going across expiration cycles. So good things are coming, exciting stuff. I hope you guys like these. I hope you enjoy them. And as always, just get involved, practice, and send us all some feedback. Okay, thanks. Bye.